So the Cornelian risk managed funds delivered a modest positive return over the 6-month period to the end of February of between 1% and 4%. During what was quite a volatile time for financial markets, there were a number of positives and negatives that underpinned that outcome. Equities were pretty positive, led by the US, and also credit delivered reasonable returns for us during the period. Going in the other direction, some of the detractors of our performance came from the UK government bond market, where investors reacted negatively to the October budget. And likewise, other interest rate sensitive sectors also struggled. So our investments in UK real estate and infrastructure also struggled as investors responded to higher interest rate expectations. I think with fixed income, the big picture for us is that the opportunity set has been absolutely transformed after almost 15 years of record low interest rates, following the savage repricing of interest rates in 2022, which caused a lot of pain for existing owners of fixed income. But on a go-forward basis, we think the yields, the expected returns are much, much more appealing. And that continues today. So where are we focused? Mainly in the investment-grade corporate credit markets. We think corporate balance sheets are in very good shape, and we think we can get very attractive returns from not taking a huge amount of credit risk, from lending to companies for a reasonably short time frame. The backup in yields has really been concentrated in longer-term yields in government bonds. And that's where we do think it's quite attractive. It's starting to look attractive with long-term gilt yields of above 5%, but that comes with a lot of volatility. And we're in an environment where we think inflation and interest rates are going to remain uncertain. So we want to focus on certain income returns by lending at the front end of the curve to high-quality corporates. I think it's beyond question that the pace and heat of geopolitical changes is definitely amplified over the last 12 months. And certainly when we're trying to anchor our asset allocation looking forward, it feels quite uncertain in terms of how countries are going to relate to each other in terms of trade, domestic tax and spending policies, etc. All of these areas are subject to a lot of change. And that really underpins the way that we're positioned today, which is to try and build resilience into portfolios, so that we're not reliant on any one on high levels of economic growth, and equally we're not reliant on any one country or any one economy to drive the outcomes for our clients' portfolios. So that diversification comes through in lots of different ways, principally by not being dominated by equities, but equally having lots of different sources of returns, whether that's real estate or infrastructure or lending to companies, lending to governments. Lots of different sources of return that can hopefully allow us to navigate through what could be an uncertain time ahead. There are a number of positives about the US stock market. It's home to some of the most amazing companies in the world, underpinned by a very entrepreneurial capitalist economy and policy framework. But equally, it's probably the only market that we see today that has characteristics of exuberant or bubble-like characteristics. It's very overowned. It's been dominated by some very simplified narratives. And we also don't think that the domestic economy in the US is likely to outpace the rest of the world necessarily in the way that it has in recent years. We are concerned about the US fiscal position and the fact that we think they're going to have to cut government spending. There's also risks around trade tariffs, etc. So some of those drivers of the positive view in the US don't necessarily feel as well underpinned as the simplified narrative are. So what have we done? We've made sure that we are investing with trusted managers in the States that are very valuation disciplined. We've also been allocating more to the small and medium-sized companies within that market to reduce that concentration risk around the large tech companies. And we've also been reducing our direct exposure to the technology sector as well, in recognition of that amazing performance and the fact that nothing goes up in a straight line and there's a lot of good news priced into that sector. So the UK stock market is hated globally. It's been one of those markets where global investors have not seen any reason to invest in the UK for a long time, whether it's because of Brexit, whether it's because they're so excited about the US, etc. But there definitely is this persistent discount that we see in UK companies. And that's part of the reason why we like the market. We can find lots of companies that are literally identical to US businesses, often with big US franchises that trade on material discounts. So we think that shouldn't really occur in global stock markets. Where you list shouldn't really matter to the valuation of an enterprise. But in terms of what's going to change that, it's very, very difficult to know. I would say that a big missed opportunity has been restoring investor confidence so far to the UK policy framework and the UK economy. We're hopeful that hopefully the policy regime under Labour government will start to transition away from hurting business through taxation changes and more towards the deregulation agenda, which hopefully could restore a bit of confidence in the market. But we don't think that's not where we're dependent on. Ultimately, we like investing in great businesses at cheap valuations, and ultimately that will result in higher returns over time. The other thing that we're definitely seeing is more M&A interest in UK companies. In the last 2 weeks, 2 of our companies have been bid for by US investors. Clearly, that sends a very strong signal that when US capital is chasing UK companies, it perhaps sends a signal that the UK stock market investor is undervaluing these businesses. I think at a high level, we think that both inflation and interest rates, which are of course interrelated, are probably going to be a lot more volatile than they have been in the past. If I think in the near term, I think there's a risk that inflation starts to go up again. The combination of tariffs for the global economy, depending on where that lands, is definitely, one would think, be inflationary. And here in the UK, we've got some very clear inflationary pressures that are a direct result of government policy in terms of administered price increases through the tax system to labour costs. And that will filter through to prices this year. But I think looking further out for the UK, certainly, as those the negative consequences of raising labour costs filter through to aggregate demand, investment decisions by businesses, etc., that will probably create deflationary pressures in the subsequent years. So we think inflation will, in the short run, increase, but possibly start to undershoot in the years after that. So what does that mean for interest rates? Well, I think we're probably at a reasonable starting point. Interest rates are a lot higher than they have been for 15 years. In general, I would say that interest rates across most economies are above the neutral rate. Certainly in the UK, 4.5% feels quite tight versus a 2% inflation target, a positive real interest rate. And that's similar in the US and also in Europe. And when I think about the forward-looking expectations of interest rates, we now have an upward sloping yield curve, certainly in the UK, where longer-term interest rates are higher than short-term interest rates. Again, that's a very healthy starting point for thinking that interest rates might end up being lower in the future. Well, I'm pretty positive on the outlook for our portfolios, but the reason is that it's got nothing to do with the global economy doing really well. And that's because we think there's so many appealing investments that aren't reliant on any one outcome from an economic perspective. There's lots of uncertainty around the direction of the global economy. But it's probably some of the most boring assets that I'm excited about, because for the first time in many years, we can generate very appealing returns from lending governments money, lending companies money, but also financing some essential assets in our economy. And it's probably those areas that I'm most excited about. And I'm talking about real assets. So investing in real estate and infrastructure. The sorts of companies that we invest into finance things like GP surgeries, supermarkets, care homes, schools, hospitals, roads, etc. Because of the period we've been in with a sharp increase in interest rates, these companies are trading on what I think are some of the most exciting valuations that I can find. And indeed, 2 of our companies in real estate that own care homes and GP surgeries have just received bid offers from US companies in the last 2 weeks. We think those long-term cash flows with inflation linkage that all of these companies provide from essential services, from financing assets which are totally essential to our communities, are offering very, very attractive returns today. And that's probably the area of our portfolio that I'm most excited about looking forward.